We further add to cash in light of growing recession risk and uncertainty around earnings. We move to neutral on equity, but within that complex, upgrade UK, Swiss, GCC equity and maintain our preference for Japanese and US companies. In fixed income, we acknowledge the move up in interest rates and therefore move to neutral on US sovereign bonds and increase our duration to a benchmark weighting. We still have a preference for real assets as a protector against inflation in portfolios, however think that a cyclical downturn could put pressure on commodities and therefore we dial back that exposure. I think the biggest risk for me is that inflation remains stubbornly high. If we look at the US as an example, there's a general acceptance that the central bank will continue to hike policy, but then will be forced to pivot due to the negative impact this is having on growth. Our base case is that central banks will continue to raise interest rates until they see a meaningful fall in inflation. There's a growing probability that we'll see further signs of slowing demand and growth, which could tip us into a global recession. We're advising clients to remain defensively positioned for the time being, and we seek further clarity on policy, profits and positioning before getting comfortable with adding to risk.